Monetary policy is the process by which a country's central bank, like the Bank of Canada, manages the supply of money and interest rates to influence the economy. Its main goal is to keep inflation low, stable, and predictable, usually targeting around 2%. By raising or lowering the key interest rate, the bank can either slow down or stimulate economic activity. For example, when inflation is too high, the bank may raise interest rates to cool down spending. Conversely, during economic slowdowns, it may lower rates to encourage borrowing and investment. In short, monetary policy helps maintain a healthy balance between inflation, employment, and economic growth. The Bank of Canada is Canada's central bank, and its main job is to control inflation, targeting 2%. Promote economic and financial stability. Issue Canadian currency. Oversee the financial system and manage government funds. Their top priority is to keep inflation low, stable, and predictable, because stable prices help the economy grow in a healthy, sustainable way. Why did the Bank of Canada hold the interest rate in April 2025? In April 2025, the bank held the rate at 2.75% for a few key reasons. Uncertainty from U.S. trade policies. Recent aggressive tariffs by the U.S. created a shaky trade environment, which could hurt Canada's economy. Potential for recession. The bank is worried that if it reacts too quickly by cutting rates further, it could weaken the Canadian dollar or trigger inflation down the road. They had already cut rates earlier in 2025 and are now assessing how those cuts are affecting the economy. So basically, they're pausing to evaluate, rather than rushing into more cuts. What might happen at the next interest rate announcement, June 4, 2025? The next move will depend on a few things. If trade tensions get worse, the bank might cut rates again to help cushion the economy. If inflation starts rising or the economy shows signs of resilience, they might hold or even raise rates later. Right now, markets are split, with a 50-50 chance of another rate cut in June. Whether it's a good idea to purchase real estate in Toronto in 2025 depends on your financial goals, budget, and long-term plans. In 2025, the Toronto market is experiencing mixed signals. Interest rates are relatively lower after earlier cuts, which can make mortgages more affordable. However, economic uncertainty tied to global trade and potential recession risks could impact property values. That said, Toronto remains a strong long-term investment due to its growing population, job market, and housing demand. If you're buying to live in the home or hold the property long-term, it can still be a smart move. But for short-term gains, it's wise to be cautious. Always review your finances, consider market trends, and consult a real estate professional before making a decision. Thanks for watching.